So in today's video, I'll be doing the Accounting 101. I'll be doing the entire section on constructing an income statement, a balance sheet, as well as the journal entries. So before we get started, make sure you're subscribed. SkillSpark is going some places. So to first do this question now, you must know when you get an exam of a balance sheet income statement, there's two ways you can test it. The first way is this way, where the adjustments, you first have to do the journal entries, then you transfer these into the statements. Or they can just say, put all these journal entries into the statements. Now, both of them are exactly the same. What we're doing now is just basically more work. Okay. So the first thing you need to do when adjusting the journal entries is the first question. So it says prepare the general journal entries for this year. Now, whenever you do this, you must understand you must have to use the general journal format. So like you'll have your debit, you'll have your credit, and you'll have the narration. Sometimes they say you must ignore narrations, but here they just said ignore dates, so you just leave out the date. So the first transaction we look at over here, 1st December. Now on 1st December, see-through increased the loan with a busy bank to 150,000. So that's just one transaction, he increased the loan. The other one deals with interest, so we just ignore it for now. So he increased the loan. So what is going up will be bank, what is going up will be the loan. So debit bank and credit loan. Now you might be thinking why we're saying debit bank and credit loan. Credit loan is a liability. You credit the liability, it's going up. So that will be the answer, right? Debit bank credit loan. So that's done. 30,000, 30,000. Perfect. Now, what you must understand is they said that increase the loan to 150,000. They never say that they increased it by 150,000. So if you look at the loan currently, which is over here, it's 120,000. So if they increase it to 150,000, that means they got 30,000 more of loan. So that is why the amount is 30,000. The next one actually we'll do the interest now. So the applicable interest rate remain unchanged. The interest is paid on an annual basis. The interest for 2022 financial year is outstanding at the year end. The loan be held for another 2. All this are nonsense. You don't need to know that, right? But if they said like it only needs to be there for like, okay, normally the loan repayment, you record a transaction, but because you're not repaying the loan within 1 year, you just ignore this, right? So you just ignore it. Now, to work out the interest, it's very simple. What you need to understand is different time periods, you had a different loan amount. For example, when it was 11 months, your loan was 120,000, right? Because now we're looking for December, transactions for December. And this trial balance was for November. So January to November is 11 months. So for 11 months, you had a loan balance of 120,000. But now in December, it won't be 120,000 because you got a loan of 30,000. So now you're adding 30, so that's 150,000. So that is why this is how you calculate the interest rate. So for 11 months, the interest rate was 120,000 times 12%. Times 11 over 12 plus 150,000 times 12% times 1 over 12 for only December will give you 14,700. Now the journal entry, now you're still owing for this year. So when you still owe an expense for this year, think of accrued expense, which is a liability. But also you're debiting interest expense because that is your interest expense for this year. So you increase that. So debit interest expense and credit accrued expense. It's 14,700, 14,700. So this is done. Now the next thing which we want to do is go to the next transaction. So you purchase inventory on credit. From clear you had a cost of 30,000. So that's a simple journal entry, purchase on credit. Think of your trade payables, which is like your creditors control. So what is increasing? It's your inventory. So that is why you say debit inventory and then you say credit trade payables with the amount 30,000 purchase inventory on credit. The next one of the owners had a private event where he took 100 glasses. The selling price was 14 Rand. Okay, so this is a drawings transaction. Whenever you get a drawings transaction, it will be debit drawings and credit what he took. In this case, inventory. So debit drawing, credit inventory. But one thing you must understand is whenever you're doing a drawings, you record the amount for drawings as the cost price of what he took, the owner. So here we're given the selling price. but we're giving the markup, so we can know the cost. So firstly, he took 100. So 100 glasses times 14 rand each they were selling. That gives you a selling price of 1,400. But we want the cost. So to do that, right, we just say 1,400, because 1,400 makes this, times 100 over 100 plus your markup, so 140. That'll give you your cost. So the cost of what the owner took the goods for is 1,000. So debit 1,000, credit 1,000. Debit drawing, credit inventory. The next one, 11 December, a customer purchased 10 boxes of wine glasses which cost 4,000 each. Okay, so a customer purchased 10. So let's see. Okay, wait, we're not in 11 December, we're on 8 December. Sold 2 boxes of camping glasses for credit for 1,680. So this is the total selling price of the two, 1,680. This is the only credit purchase that Dynash made. All inventory is 40% of markup. So what you need to do is record this transaction. Whenever you record, so you know how you get, so now the most important part is this is a credit purchase, right? If it was a bank purchases, you know what it is. It'll be debit bank, credit sales, debit cost of sales, credit trading stock. But instead of bank, we're going to say trade receivables. Yes, trade receivables. So we'll say debit trade receivables because the debtors are going up, credit sales because that's going up. Then we're going to say debit cost of sales, credit inventory. But the most important part is when you say debit trading receivables and credit sales, we record the selling price. But when we say debit cost of sales, credit inventory, we say the cost price. Now they're telling you over here 1,680 they sold it for. So this has to be the selling price, right? So that is why you debit 1,680, credit 1,680. Now maybe thinking how to work out the cost of sales. They tell you the markup is 40% on cost. So if you got the selling price, it'll be 1,680 times 100 over 140. That'll give you 1,200. So that's how you do it. The next one, a cash customer purchased 10 boxes of wine glasses which costs 4,000 total. Simple transaction. It's cash, so it affects your bank. So your bank will increase. So debit bank, credit inventory. So debit bank, credit inventory. Where is it? Yes, debit bank, credit inventory. No, wait. A cash, yeah, 11 December. Let's see, where is it? Oh, yeah. Oh, no, wait. Debit bank. Oh, sorry. This is a sale. So it's debit bank, credit sales with the amount of the selling price, which is 4,000. So that is why you say debit bank. No, wait. Oh, wait. It's a cost of 4,000. So now they didn't give you the selling price. They gave you the cost. But you know the transaction will be debit bank, credit sales, debit cost of sales, credit inventory. Now you know the selling price needs to be here, the cost needs to be here. Now they give you the cost, so just put the cost down here. But now how do you work at the markup? Because we want the selling price. So now you say 4,000 times 140 over 100. That'll give you 5,600. The next one, a debtor paid 13,000 into the bank account. So your bank account is increasing. So it's debit bank, credit trade receivables. So debit bank, yes, debit bank, credit trade receivables, right? Yeah. Now over here, See-Through was informed that Dynash had been declared insolvent. So you only were able to pay 900 Rand, and he'll pay this 900 Rand on 2nd January. Now what you must understand is this. The transaction which we're going to record now in December is going to be the bad debts written off. Because this 900 Rand is useless right now because he's only going to pay this next year. So why are we recording it now? We don't need to. So what was his balance before? Now Dynash, if you look at his previous transactions over here, we sold it to him for 1,680. We'll actually see it somewhere here. Let's see. Yeah, over here, 1,680. So he owes 1,680. So if he's going to pay next year 900, what are we not going to get? So it's 1,680 minus 900. So we won't get 780. So this month we have to write it off. So it's debit bad debt and credit. Now this is supposed to be trade receivables. I don't know why they got allowance for doubtful debts, because we know the debtor. So if we know the debtor, it'll be credit trade receivables. So I don't know why they got that there, but yeah, that should be correct. The next one, 28th December. So you had an accrued rental income balance on 1st of January. If you look at this, you see, now whenever you get this, now just think about it logically. So the bookkeeper is unsure to treat the rental income. He's not processed this entry as yet. So that's one transaction, and then we'll see the next transaction after. So accrued rental income is 5,500 on 1st January. Now think about it. Rental income accrued for this year will be last year. So basically, this is what you need to understand. When you receive rental income, you receive the cash. The person will give you the money. So the transaction will be in this month debit bank, because the bank will be increasing, but it will be credit of whatever the accrued is. So accrued rental income. So that will be the answer. So debit bank, credit accrued rental income. Because I'm going to ask yourself, when you got this, what was your transaction? Your bank increase, but your credit rent income, because the income for this rental is not for this year, it's for last year, so you have a minus. Then let's see. Okay, so now this one here, the other part of the question, the rental agreement indicates the rent is received in arrears on the first day of the month. So basically, if you think about arrears, it's basically you receiving the rent the next month. So if I'm renting a premises for January, I'm only going to receive the money in February. So with that being said, the December rent, you're only going to receive it in January. So that means for this year, that one rent you're not going to receive. So you already know that it's going to be debit accrued rental income. Accrued, you should have received the income, but you never. Credit rental income. But now you must ask how to calculate the amount. Now there's lots of ways to do this. Some people use solve for X, some people use other fractions. It really does depends, but what you must understand, how I did it, it's simple. I just took now the keyword is saying over here, the rate increase on 1st July. So what was the normal rate? So January is your beginning of financial year, so January, February, March, April, May, June. So for 6 months, your interest rate, no. January, February, March, April, May, June. 6 months, yeah, 6 months. So for 6 months, your rate was normal, 10%. But then, July, August, September, October, November, 5 months, it was increased. Now, why I say 5 months and not including December is because this trial balance over here, 30th November, is 11 months, it's not December. So this rent income, where is it here? Rent. Yeah, this includes till November. Now, what you must understand is, to record this, I can use solve for X. So I can say 5, let's see. So how many months is it? January, February, March, April, May, June. So 6x plus 5x times 110% x is equals to this amount, and we'll get x to be 5,500. But now you want the 110% of x. So 110% of 5,500 is 6,050. But no matter how you do it, it's like so much of ways. In fact, my way, probably not a lot of people will do, but that's how you get it, right? So debit accrued rental income, you're supposed to receive this, and credit rent income. Now, the bookkeeper incorrectly paid the telephone account, which reflects the amount of 1,500 twice. Now, in this transaction, what you must understand is, when he paid it twice in November, he already paid it in December already. So that's fine. So when he paid December, the 1,500, it's for the next year. So that is why you say debit prepaid expense, and expense you already paid for this year for next year. Credit bank, right? That's done. Then the next one, purchase furniture, that'll be easy. Debit furniture, credit bank. Now these last two will be simple. So debit bank charges, credit bank. Anytime you get this, it'll be debit depreciation, credit accumulated depreciation on vehicles, because vehicles are the only thing getting depreciated in this business. Finally, stationary expense, you minus it, so you debit expense, credit